Greetings, fellow financial adventurers. Welcome to our channel Snap Savings, your fortress of financial wisdom.
Imagine this. The average American family takes on a mortgage of over $300,000. That's a significant amount of money, and it represents a long-term commitment that can span decades. That's like carrying around the weight of a small house on your shoulders. It's a burden that can feel overwhelming at times, but it's also a step towards achieving a major life goal. It's a huge financial commitment. But for many, it's the path to achieving the dream of homeownership. Owning a home is often seen as a symbol of stability and success, a place where families can grow and create lasting memories. But before you jump into the world of mortgages, you need to understand what you're getting into. It's not just about signing on the dotted line, it's about comprehending the terms, the obligations, and the long-term impact on your financial health. Knowledge is power, especially when it comes to your money. The more you know about mortgages, the better equipped you'll be to make decisions that are in your best interest. Let's break down this complex world of mortgages into bite-sized pieces. We'll start with the basics and gradually move into more detailed aspects, ensuring you have a solid understanding of each component. We'll explore what a mortgage is, how it works, and the different types you can choose from. Fixed rate, adjustable rate, FHA, Virginia, and more. Each type has its own set of benefits and drawbacks. We'll also delve into interest rates, loan terms, and other crucial factors that can make or break your homeownership dreams. Understanding these elements can help you choose the right mortgage for your situation. Remember, this isn't about becoming a financial expert overnight, it's about empowering you to make informed decisions about one of life's biggest investments. It's about knowing what questions to ask and what red flags to look out for. This journey is about more than just understanding financial jargon. It's about taking control of your future. It's about making choices that align with your long-term goals and financial well-being. It's about having the confidence to navigate the housing market and make choices that align with your financial goals. Whether you're looking for your first home or considering an investment property, the principles remain the same. So, whether you're a complete beginner or just need a refresher, join me as we unlock the secrets of mortgage loans together. We'll cover everything from pre-approval to closing and everything in between. This is about more than just buying a house. It's about building a secure financial future for yourself and your family. It's about creating a foundation that will support you for years to come. It's about having the peace of mind that comes with knowing you're in control of your money, not the other way around. Let's get started. We'll begin by understanding the basic concept of a mortgage and why it's such a crucial part of the home buying process. A mortgage is essentially a loan used to purchase a home. The home itself serves as collateral for the loan, which means if you fail to make your payments, the lender can take possession of the property. This is why it's so important to understand the terms of your mortgage and ensure you can meet your payment obligations. When you apply for a mortgage, the lender will evaluate your financial situation to determine how much they're willing to lend you. This process involves a thorough review of your income, credit history, and other financial factors. It's a good idea to get pre-approved for a mortgage before you start house hunting, as this will give you a clear idea of your budget and show sellers that you're a serious buyer. There are several types of mortgages to choose from, each with its own advantages and disadvantages. Fixed-rate mortgages have an interest rate that remains the same for the life of the loan, providing stability and predictability. Adjustable-rate mortgages, on the other hand, have an interest rate that can change over time, which can be beneficial if rates go down, but risky if they go up. Government-backed loans, such as FHA and VA loans, offer benefits like lower down payments and more flexible credit requirements, making them a good option for first-time homebuyers or those with less than perfect credit. It's important to compare all your options and choose the one that best fits your financial situation and long-term goals. Once you've chosen a mortgage, you'll go through the closing process, which involves signing a lot of paperwork and paying various fees. This can be a stressful time, but it's also the final step before you get the keys to your new home. Make sure you understand all the terms and conditions before you sign anything, and don't be afraid to ask questions if something isn't clear. After closing, you'll start making monthly mortgage payments, which will include both principal and interest. It's important to budget for these payments and make them on time to avoid late fees and potential damage to your credit score. Over time, as you pay down your mortgage, you'll build equity in your home, which can be a valuable financial asset. It's also a good idea to periodically review your mortgage and consider refinancing if interest rates have dropped or your financial situation has improved. Refinancing can help you lower your monthly payments, pay off your mortgage faster, or tap into your home's equity for other financial needs. Homeownership offers many benefits, including the potential for property value appreciation, tax advantages, and the ability to customize your living space. It's also a way to build wealth over time as you pay down your mortgage and your home's value increases. But perhaps the greatest benefit of homeownership is the sense of pride and accomplishment that comes with owning your own home. It's a place where you can put down roots, create memories, and build a future for yourself and your family. So as you embark on this journey, remember that knowledge is your greatest ally. Take the time to educate yourself about mortgages, ask questions, and seek advice from trusted professionals. With the right information and a clear plan, you can navigate the world of mortgages with confidence and achieve your dream of home ownership. Let's get started. A mortgage is simply a loan specifically designed for buying a home. It's like borrowing a large sum of money from a lender and promising to pay it back over time, with interest. Think of it as renting money to buy a house, with the lender holding the title until you've paid back the loan in full. This loan is secured by the property itself, meaning if you fail to make your payments, the lender has the right to take possession of the house. This is why it's crucial to understand the terms of your mortgage and ensure you can comfortably afford the monthly payments. Typically, mortgage loans are paid back over 15 or 30 years, although other terms are available. Each month, your payment goes towards both the principal, the original loan amount, and the interest, the cost of borrowing. Understanding how these components work is essential to managing your mortgage effectively. Remember, a mortgage is a significant financial commitment, and it's crucial to approach it with caution and a solid understanding of its mechanics. Don't be afraid to ask questions, shop around for the best rates, and negotiate terms that work for your financial situation. Now that we've covered the basics of what a mortgage is, let's dive into the different types of mortgage loans available. Knowing the differences between these options is crucial for choosing a mortgage that aligns with your financial goals and risk tolerance. The two most common types of mortgage loans are fixed-rate mortgages and adjustable-rate mortgages, ARMs. Each has its pros and cons, and understanding their unique features will empower you to make an informed decision. Fixed-rate mortgages offer the security of consistent monthly payments over the life of the loan, while ARMs come with fluctuating interest rates that can lead to unpredictable payment changes. Your individual financial situation, risk appetite, and long-term plans will determine which type of mortgage is right for you. In the following sections, we'll explore both fixed-rate and adjustable-rate mortgages in detail, examining their advantages and disadvantages to help you determine the best fit for your unique circumstances. Section 4. Fixed-rate mortgages, predictability and stability. Fixed-rate mortgages are the most popular choice for homebuyers, and for good reason. They offer predictability and stability, making it easier to budget for your monthly housing expenses. With a fixed-rate mortgage, your interest rate remains the same throughout the life of the loan, no matter what happens in the market. This means your monthly principal and interest payments will never change, providing peace of mind and financial stability. This predictability is particularly attractive to first-time homebuyers or those who prefer to avoid potential payment fluctuations. However, it's important to note that while your principal and interest payments remain constant, other costs associated with homeownership, such as property taxes and homeowners insurance, can fluctuate. These expenses are typically included in your monthly mortgage payment through an escrow account which your lender manages. Overall, fixed-rate mortgages are a great option for those seeking stability and peace of mind in their monthly housing expenses. The consistent payments make budgeting easier and provide a clear picture of your long-term financial commitment. Section 5. Adjustable Rate Mortgages, ARMs, Navigating Fluctuations. Unlike fixed-rate mortgages, adjustable-rate mortgages, ARMs, come with interest rates that can change over time. This means your monthly payments can increase or decrease depending on market fluctuations. ARMs typically start with a lower introductory interest rate than fixed-rate mortgages, which can be appealing to some borrowers. However, it's crucial to understand that this lower rate is usually temporary and will eventually adjust based on a specific benchmark index. The frequency of these adjustments and the maximum interest rate cap will vary depending on the specific ARM product you choose. ARMs can be a more complex financial product than fixed-rate mortgages, and they come with a higher degree of uncertainty. It's essential to carefully consider the risks and potential benefits before opting for an ARM. If you're considering an ARM, it's crucial to understand the index used to determine rate adjustments, the frequency of adjustments, and the maximum interest rate cap. While ARMs can offer lower initial payments, they also introduce the risk of potential payment increases in the future. Carefully assess your financial situation, risk tolerance, and long-term plans before deciding if an ARM is the right choice for you.
Don't forget to like, share, and subscribe for more profound insights into mastering your financial journey.